Assalamu Alaikum everyone, welcome to another video. In this one we are looking at 11 different companies that have grown their dividends double digits in the last 5 years. And I will explain how important that is, but let me first of all talk about what dividends are, why it's important, and then we will look at these companies at the end. Now, the reason I absolutely love dividends is because someone is paying you money, okay, while you sleep. You buy a share in a company and they pay you every single quarter. That money then gets reinvested into the same stock or different stock, which then generates more money or more dividends, which then starts that snowball effect that we're all after. And obviously my goal, I've always said, is to at some point in my life, I don't know if that's going to be next year or year after or 10 years from now, okay, I want to replace my full-time job with my investments. If that means I will get enough dividends to live off, then alhamdulillah, that will be perfect, right? So the goal is that, but you never know what's going to happen. And obviously my portfolio, as you can see now, between this one and the Freetrade is about 41,000 pounds. Now, that's not a lot of money. That's a lot of money, first of all, but in the grand scheme of things, okay, that is quite small to actually generate dividends that will help me live off in the next whatever years. But the plan is to grow this portfolio and focus on companies that do pay dividends, that are mature and so on. And this is the whole basically video. I want to talk about how important dividends are and what they allow you to do, and just focus on that, because right now there's so many brand new shiny companies out there that just came up in the last couple of years or couple of days that are trading high multiples. And there's nothing wrong with these companies. They're amazing companies, great products, blah blah blah, but the issue is these companies are not mature companies. Now you can argue and say, okay, the high risk, high reward, because a lot of these companies obviously are very new. They have a lot to grow, and once the market understands the value of these companies, they will be 10x or whatever, and that's absolutely fine. I'm not against that. I do own some growth companies in my portfolio, including Teslas and Salesforce and so on, that do not pay any dividends. But I do prefer the mature companies because I want to know where this company's been, and I want to know where it's heading. Whereas the newer companies is slightly a bit more trickier. So you can have a portfolio of a bit of both, but I do love the dividend side of it because I do love that snowball effect when you buy a share in a stock, then they pay you, that money then gets reinvested, that money then get paid more dividends, and that dividend snowball effect starts, which is what I'm after. So let's start first of all and talk about dividends, okay? So according to Investopedia, dividends are distribution of corporate profits to eligible shareholders. What that means is a company makes money, they have a revenue, then they pay off everything they need to pay off. Then the net profit or the net income then is used to pay off dividends, to buy back shares, loads of reinvest in the company. So they do loads of different things with that money, and one of them is to reward shareholders and pay them back, okay? And normally the companies that pay dividends are mature companies. So large companies, more established companies with more predictable profits are often the best dividend payers. And this is what I've been focusing on since I started investing. I always focus on companies that I know I've been around for a long time. They have a predictable profits because what they're making, what they made in it before, and the type of products they sell and so on. I also have companies that are quite young that started paying dividends, especially like tech companies. But some of the companies that pay, like mature companies that pay, include the basic materials, oil and gas, banks and healthcare, utilities. These are some of the best companies, and obviously REITs as well, which I don't own any REITs at the moment, but I am planning to do a little bit more research. There's a couple of companies I've got on my short list. I haven't looked at them recently. So that's one of the basically what dividends are. Now I'm going to explain to you, and I've been doing a little bit of research and I found this. So this is a research carried out by this company, and they've done, basically they looked at since 1972 up to 2019, right? And what you see here is the return, okay? So the average annual return from since 1972 to 2019. And what you see here is the dividend growers, not just dividend payers, dividend growers. So these are companies, the ones that we're looking at today are basically in this category. So dividend growers companies have returned almost to 13%. All dividend paying stocks, including the ones that do not grow it, obviously have almost as well similar sort of a return. Then the S&P 500 index, 12.3. Then you've got dividend payers with no change in dividends, so the companies that do not increase at all. And then you've got non-dividend paying stocks, and then you've got dividend cutters companies. And as you can see, the best of this lot is the dividend growers, and this is what I've been focusing on. So a lot of the companies that I bought in my portfolio are dividend growers, and for this reason. I don't focus on high yield companies because they can cut their dividends anytime soon. I own Rio Tinto. That is the only company that I feel like will cut their dividends soon. The reason for that is because the iron ore prices are very, very low at the moment. They keep crashing. And if that continues doing, because the stock is really, the company is basically, majority of their revenue comes from that iron ore. And because iron ore is known, China is not basically doesn't have as much demand as they had before, is now being, going downhill, if you like. So that is one of the companies that I'm watching at the moment. But majority of the companies are in this category here. There might be one or two that pay dividends, but they don't basically increase it as much. But the ones that I've basically focused on is the dividend kings and dividend aristocrats. And these are in that category. So this, to me, is perfect because the non-dividend paying stocks return about 11%, which is absolutely fine. Obviously, you can argue, right, price appreciation is higher when it comes to the non-dividend paying stocks because they appreciate very fast, and these are companies that are growing and so on, okay? But at the same time, equally, dividend growers have actually outperformed overall returns, including price appreciation, as well as the dividends and so on. So total returns, that's what we're looking at, annual total returns. So they've done better, okay, than the non-dividend paying stocks. I'm not saying they're bad, but I'm saying this is what the research shows. The next thing I want to show you is this. We've got another research, different company. You've got high return, and you've got low return and low risk and high risk. Now, what we're looking at is the dividend growth stocks have outperformed with less risk. So risk, again, you kind of need to watch out for that because, when the stock market goes down 30 whatever percent, if these companies are not as volatile as the rest of the stock, then you're not going to lose a lot of money, right? And that is something that's important to us as investors because you don't want to lose a lot of money. Now, 1973 to 2020, they've done this research, and what it shows here is dividend growers have higher return and a low risk. If you look at the next category, is the dividend payers with no change have had kind of good returns with a kind of lower risk. But on the other end, you've got dividend cutters that are higher risk and low return. And then you've got non-dividend paying stocks, which is kind of medium here, okay? So high towards almost a high risk and medium kind of returns. So again, two different categories. One looking at the total returns, and then the other one's looking at the risk associated with this and how volatile these stocks are. And this is something every investor should, because nobody wants to lose money and everyone wants to make money. And that's what we're looking at. So your risk is reduced here and your return is actually increased. And that's all I need. And I can sleep well at night knowing that I can own these sort of companies. I'm going to get good returns or high returns with low risk. And this is it. So let's now look at these 11 different stocks. So the first company that we're going to look at is a company that have been in the news the last couple of days, Johnson & Johnson. If you haven't heard the news, Johnson & Johnson is splitting into two different companies. one focusing on the consumer products and the other one pharmaceutical business side of it. This is going to happen in the next 18 to 24 months, so it's not going to be overnight, but that is something exciting to watch out. So I don't know much about it, so once I have more information, I'll probably do a video and talk about it. But I'm not changing my position. I've got 20 stocks, 20 shares in this company, so I'm happy with that. I'm going to keep it, probably add to it, leave it as it is. Okay. Now the company has a high PE at the moment, almost 25 at the moment. They do pay their dividend yields 2.57, 5-year growth rate of 35%. That is super good for a company that just uses their net profit. So the net income, they're only using about 43%. Normally we say anything below 61% is perfect. And look at this, the dividend growth, they've been growing their dividends for 59 years consecutively, non-stop. They have free cash flow here, and this is one of the things I've always spoken about. And this is what the companies use to pay dividends, to reinvest in the company, to buy back their shares, to basically grow the business. And this is very important. According to Morningstar, the stock is currently fairly valued. Okay, so that's the Johnson & Johnson, one of the best companies in the world, in my opinion. The next one is Lam Research Corporation. This is in the semiconductor equipment. So what they do is they come up, basically they deal with the equipment side of the semiconductor world. They have 1% dividend. They have grown that dividend in the last 5 years, 35% or more. The payout is very low. They have done this for the last 5 years, and they've got $3.2 billion in the bank to pay that off. And they are fairly valued at the moment as well. So in terms of this company, I do not own it at the moment. I've done a bit of research about it. I really like it. I might wait for a drop because fairly valued is still good, but I want to buy it undervalued. Okay, hopefully once if it drops a little bit, then I might actually buy a couple of stocks. So the next one we're looking at is Lowe's. Lowe's is one of the companies that I own in my portfolio. Their dividend is 1.37. They have done this the last 5 years. They've grown their dividend about 17.3%. Payout ratio only 28%. And they have been increasing their dividends for 47 years non-stop. And they have $9.2 billion to reinvest in the company, pay off dividends. At the moment, they are 33% premium, meaning they are overvalued at the moment. So I wouldn't touch it yet. I do own, I think, about 6% shares. So I'm going to keep that for now. The next company I want to talk about is Broadcom. Again, it's a semiconductor company I own in my portfolio. I've talked about this company where it was way undervalued, and I'm happy that I actually invested because right now I don't know. In fact, let me see quickly. It's basically up about 26%, so which is really good for me. They have 2.6% dividends and about 50%. They have grown 50%. It's actually crazy. It's almost. Again, this is absolutely amazing to see a company this big to grow their dividends for 49 years non-stop. 49% in the last 5 years. For 10 years, they have been doing basically paying these dividends, but they've grown just the last 5 years, 49%. The payout is only 51%, and they have $13 billion in the bank. But right now, again, is another 39 premium or overvalued company right now as we speak. So I wouldn't touch it. I think I own 5 shares, so I'm going to keep those. And if I see a drop, I will buy this because I really do love this company. But again, 49.3% 5-year growth rate, which is absolutely brilliant. Now, the next one is Visa. Visa is a new addition to my portfolio, so about a couple of months. Again, they don't pay the dividends. It's not a lot. I've done a video just not long ago. So if you want to check that out, go for it. About 18% 5-year growth rate. And then you've got payout ratio, just 21%. and then 13 years of non-stop paying, growing their dividends, and you've got about $14.5 billion in the bank to pay off everything else. Then you've got MasterCard, which is again very similar, okay, to Visa. So about 18% again, 5-year growth rate, 21% in terms of payout ratio. The payout is basically the net income. So out of the net income, how much are they spending on paying the dividends? Okay, so you want something below 60%, which is good. Then 7 years of paying this, and they've got about $7.8 billion in the bank. Okay, again, the dividend yields are not great, but I'm not after the yield, because if you're chasing a yield, there's a danger that you're going to end up with companies that are not great, that do not have enough free cash flow to pay off the dividends, and they will have a high payout ratio, and they're going to end up cutting it. So I'd rather have these companies to actually reinvest in the business, okay, and pay me something small. And then obviously you're going to get, these two are growth companies. All three of them here are actually growth companies. So they grow in their business, as well as all of the companies, in fact, in this list are growth oriented businesses, because they grow their revenue, top line revenue every single year, bottom line revenue side as well as that they actually pay you dividends and they grow the dividends, which is what we are after. So the next company is Home Depot, very similar to Lowe's. They are very overpriced at the moment, but they have 1.77% dividend yield, 5-year growth rate of 19.3, 45% payout ratio, and they have paid this or grown this for the last 12 years. They've got about $11.5 billion in the bank to pay that off. Great company. I do own it, overvalued at the moment. I'm not adding to it anytime soon. Then is Medifast. I've done a video on this company. I do not own it, but they have 2.56 billion dividend yield. They have 48%. When I saw this company first time, I was really blown away. But my only concern is the free cash flow here. So the free cash flow isn't a lot, and they are actually paying a lot of, basically they're growing it very, very fast. Okay, the payout ratio is low, which is nice, but my only concern was this just less than $1 billion in the bank to pay off that dividend. Okay, so it's a great company. They are in the weight loss, health living products and stuff like that. So they do own the really great products. So if you want to check that out, I've done a video. I'll share that as well on the link below. And then the next one is Air Products and Chemicals. I own this company in the materials sector. Really good company. A lot of the big companies that basically that are doing basically anything to do with the oil, anything to do with chemicals, energy, whatever, they actually deal with this company directly. So which is good for me. About 2% dividend yield, 12.79 5-year growth rate, and 57% of their money goes to paying that dividend. And they have been doing this almost over 40 years, which is a long time if you think about it. They only have $1.5 billion in the bank to pay off that dividend, and they currently discounted. So they currently 9% discounted, meaning they are undervalued as we speak. Next one, we've got two more, is TSM. Again, it's one of the biggest semiconductor companies. It's foundry companies. So that means they make it. They don't design it. So companies like AMD will design the chip and they will make it for them. So they have 1.55% dividend yield, almost 14.18 5-year growth rate, and 44% or 45% payout ratio. They have been paying their dividend 5 years consecutively, and they've got about $9 billion in the bank, and right now 18% discounted. So really way undervalued at the moment. Final company we're going to talk about is in the financials, and this is SPGI. I would love to buy more of this company, but I feel like still a little bit priced. I wanted it to be below at least 300. And if I can get below 300, that will be absolutely brilliant. The dividends are not a lot. So this is the company that comes up with all sorts of ratings for different companies. So they are the S&P 500. So they comes from, so they own basically the S&P 500, the Dow Joneses and all of that. So they do the research behind it, they help companies, they rate companies, they look at the different financial metrics in different companies, and they're the ones who come up with different ratings for these financial institutions. So in a very good business, because it's especially when there's recessions, when the inflations and all that, they're the ones who end up doing the research, come up with the plan and so on. So at the moment, they have been growing their dividends. It's about 16% over the last 5 years. Payout ratio very small. 16 years of paying an increase in their dividend, and they've got $3.7 billion in the bank. Currently 14% premium, which means it's slightly overvalued. So like I said, if I ever see this company below 300, I will definitely be buying. I have literally, I think about £20 or £10 or something like that in this stock, because I want to keep an eye on it and I want to see when it drops, hopefully, and I can buy more. Right. The reason like I said at the beginning, the reason I wanted to share this with you is, number one, to show you what the research says about dividends, because there's a bad rep out there. People talk about, oh, dividends, why would you want to do that? What's the point? You rather buy, the high flying companies. Yes, that's absolutely fine. But the research shows the dividend growers, the ones that we looked at now, outperform than what the rest of the different sectors. Okay. Top of that, they are low risk and high returns. Why not? So if that is what you're looking for and you want basically consistent income. So if you look at my overall portfolio here, okay, let me in fact show you one other thing. So this is my portfolio in Simply Safe Dividends. Dividend growth for this year was 12.7%. Last through 5 years, okay, the companies that I own basically grew their dividends 11.1%. And the last 10 years, they've grown about 11%. And as you can see, it's been trending upwards. Now, let me show you a great example of this. Amgen is one of the companies that I own. I own 10 shares. So if I had these 10 shares in 2011, they would have paid me $5. Right now, as we speak, 2021, they paid me $70 for owning for those 10 shares. Now that's $65 more than what I started with. Every penny, every time they paid me, that money then it gets reinvested into the same company or different company, which then generates more dividends, which then starts the snowball. And this is why I absolutely love dividends, because these companies are increasing the dividends here without you doing anything about it. And if you look at it for example, the company that we just looked at, Broadcom, 10 years ago, they would have paid me $2. Right now, they're paying me $72. $70 more than what I've started with. And this is what all you want to see. This is Johnson & Johnson, again, $45 in 2011. Right now, $83. Okay. And this is what I love. So when you look at this, and the trend is upwards from $5 to $70 in the space of 10 years. If you hold that and you get that much and you reinvest that, it will increase obviously over time. Okay. And this is what they were paying. So 2011, they were only paying 0.28%. Right now is a different. So right now as 2021, this is what they are paying per share as of December. So this is why I absolutely love dividend investing. Again, don't get me wrong, when it comes to the overall portfolio, you need to have a balanced portfolio, and that's why I do have growth portfolio that focuses on the Teslas, the CRM or the Salesforce and the CrowdStrikes, even though I've got a little bit of CrowdStrike. Okay, I absolutely love these companies, but at the same time, I do enjoy the passive income side of it because I don't have to do anything. I just buy these companies, hold them, and then they pay me, and then I reinvest that money into it. So right now, my prediction for this year, okay, this time next year will be £756. And hopefully by the end of this December, I want to have at least 1,000. That was my target. I want to see if I can beat that or even get to that. So if it happens, will be perfect. If it doesn't happen, it's fine. So while I'm actually waiting for getting paid this much, my overall portfolio, this is the dividend portfolio, is up about 14%. Total gains is £4,615. So it's going up in terms of the price appreciation and the dividends as well. So this is then is reinvested, which then creates more gains and more dividends. And that's the snowball thing I was talking about all day. Again, I love my growth portfolio, nothing wrong with that, okay? But unless you sell it, it's unrealized gains. Again, obviously there is the same, but this money is realized gains that you've actually get it, and then you can use them for something else, right? I didn't want to make this video that long, but I wanted to make the point clear of why I absolutely love dividend and why it's important to me. And for the long run, if I can replace my 5 to 9, 9 to 5 job with this income, it might take me years, but if I can do that, alhamdulillah, I'm happy with that. If I don't get that, but get closer to where I want to be, even if it's this and something else combined together that gives me that freedom, alhamdulillah, I'm happy with that. I hope you enjoyed the video. I know it's a very long one, but I wanted to make it long. I want to make sure that you understand the research and understand the concept, and show you practically what is possible if you focus on dividend growth portfolio side of things. I hope you enjoyed the video. Please, if you enjoy it or you find any value in this, please like, subscribe, and let me know if you have any questions. And inshallah, I'll do another video at some point this week. And these are the 11 companies that I wanted to share with you. So you can pause it, have a look at them, and do your research, inshallah. Assalamu Alaikum.